So let's get some more analysis of the implications for the broader Australian economy and the Australian dollar too, with Mark Todd, who joins us from Big Securities in Sydney. Now, Mark, good morning to you. How significant do you think the floods are going to be in the RBA's upcoming decisions on interest rates?
Oh, I think it'll have a significant impact. I mean, I think the fact that we've got board members coming out now talking about it is certainly a precursor to their attitude. I think the November tightening caught people unawares, and so I think they're now trying to move the markets into an expectation that the rate rises are off the table at the moment.
Well, is it they that are moving those expectations, or the money markets kind of trying to set the agenda? And often when they try to do that, the RBA says, you can think all you like, we'll do differently.
I think, yeah, they like to work to their own agenda, but the reality is that this is a massive amount of damage that are done in the food bowls, and then we don't know what will happen with the mining receipts. So, you know, I think as much as you might want to talk about it, it is significant damage.
Well, that mining receipt issue is not the argument that higher prices can be extracted on the back of this thematic, and if anything, that will keep that terms of trade story, which the RBA said was, if anything, so inflationary, it'll keep that alive.
Yeah, and I think it's not just the mining receipts, it's the infrastructure around that mining receipt. So it's the actual, there's a rebalance of that. So I think the CPI issue is important, but I think the RBA can talk the CPI around the expectations around, if we see increases due to damage, you know, the flood damage, they can say, well, we'll bear that CPI increase, and we'll just see what it is over the longer term.
Yeah, just on the CPI, if we get these huge spikes in food prices and vegetable prices that we're hearing of, does that then get excluded in all the statistical, you know, moving around when they exclude those more volatile items? How does that actually then flow through back into the CPI? Yeah,
well, they'll look at the core CPI and they'll then say, okay, what are the factors that are affecting the CPI changes? So is it a long-term trend? Are people looking for more money in terms of wages? Is it if it's an issue around flood and damage around the infrastructure that these floods will cause? They'll say, okay, what's the duration to get this fixed? So I think it's manageable.
Okay, so they will kind of assess the damage as they go. They make assessments based on the kind of numbers they start to come through?
Yeah, correct. Yeah. They just don't take the raw number and say that's the number and that'll be the number in perpetuity. That won't be the case.
Okay. Yeah.
Mark, like it or not though, we keep telling people this is a 12-month view that the RBA takes each and every month. It's not just having to react month on month. To that extent, how do you see through it and justify a rise or a holding back?
Well, as I mentioned earlier, the November rise, I think it would be fair to say it caught most people unawares. So I think they were expecting that bias was out of the market. So I think what they're trying to say is they'll take the rising temperature out. They'll say, let's just review it over the next 6 months and see how we adapt to the changes that are coming. You know, and I think it's important to look at what the currencies are doing. You know, if you see a rise in the Aussie and you're looking at those industries that'll be affected, which is in the mining and in the farming, you know, they won't want to see that either.
Do you think the flooding is going to provide scope, I suppose, for further weakening for the Aussie dollar then, based on what you've been saying?
I think a lot of people have talked about a modest rise in the US dollar against the Aussie, so I would expect that might continue on. I think we're seeing that jobless growth in the United States, it's stabilised. It's not, we're not seeing any increase in the joblessness, but we are seeing a recovery in the States around corporations being able to, you know, be more productive. So you might see a rally in the US dollar from that.
We're not seeing, though, any recovery in state debt. It's interesting, not only should we be talking about the nationwide issue for Australia and these floods, but very much Queensland's own debt burden here. How is that understood as well? I mean, could it be an argument put forward that it is a Queensland state debt issue and not a nationwide debt issue?
Oh no, I think we're looking much more macro. I think everyone looks at it as global. I don't think they're going to be able to, certainly international investors are not going to say this is Queensland only. They'll look at this as Australia-wide.
With the currency moves on the back of this, what are you seeing in terms of, I mean, you're watching debt markets all the time.
Yep.
The Australian dollar, even despite all of this, has still remained above parity with the US. How are you seeing that affect interest in the Australian market?
Well, we have seen a growth in the level of offshore interest in the Australian market. I think they like the look of the rates. They like that sort of 6 to 10% rate that they're going to get. Traditionally, they look to hedge up that foreign exchange, and I think we're looking at a modest rise in the US market, and Australia becomes a very good story for hedging your bets. So if you were to take 10% of your assets and put it into the Australian story, which is a good story, you know, we're still feeding into those, China, you know, India, as that becomes a more urban economy, we're fed into that business, and that's an easy story to sell. So I think they like that debt market, and so now they're looking to take a little bit of foreign exchange risk with that debt market.
You know, so you're making that distinction between, you know, an appetite there, but not an appetite for equities from international investors. There's a bit of a dislocate.
Yeah, there is a little bit. I mean, I think obviously our focus is in the debt market, so we're not focused as much on the equities in terms of, you know, there's a lot of people making the equity story. I think the debt market is a different animal at the moment. I think it's around that credit risk. I don't think, I just think the equity piece is a little bit more complex, whereas the debt market is a, you know, it's a manageable analysis. You know, you want to work out, will they be able to pay back their debt? If I take on Australian bank debt, will I get my money back? I think that's an easier analysis for an offshore investor.
Where's the smart money going to be made for local investors then?
Well, I mean, we still like that 1 and 2 year part of the curve where we're seeing Australian bank debt around that mid-6s, 6.5%. So we like the look of that. I think that's still an attractive piece. The banks are quite aggressive out there trying to win that sort of deposit market.
And do you feel that when we're looking at kind of returns for 2011, there's decent returns that people can get in this space?
I mean, I think it's very hard in 2011 to say what the year will look like. But I think historically, if you can make 6.5% on your cash component of your portfolio, that's a reasonable return.
Is it kind of the case that those returns are going to be achievable year on year, given Basel III, the fact we don't still know with certainty what the impact of that will be on banks?
Correct. I mean, I think one of the things we are aware of is the fact that they will want that retail deposit money. That's very clear from all the banks. So those returns will be good for the retail depositor. If you're looking at a more professional entity, you know, it might be harder to get some of those returns because of the way the Basel III review that entity. But for the retail deposit and probably your viewers, you know, you should be able to get something in the mid-6s.
I guess you've got to be minded to look at the equity market performance, the calls that are being made now, simply because it is that war for, you know, people's cash. Do they park it inside their, you know, on term deposit, or do they actually go into equities and take their cue on the back of those gains that are projected?
Yeah, well, I think we've been encouraging a lot of people to, you know, have a balanced portfolio, and I think if you look at a balanced portfolio, you're going to have a segment in cash, a segment in debt, and a segment in equities. When it comes to that segment on the cash piece, you need to make a decision: is 6.5% a reasonable return? On the debt piece, you need to make the decision: the returns you're getting for the risk you're taking, is that a reasonable return? And for the equity piece, I mean, that's a much more complex piece. If you're trying to make the analysis of whether bank stocks will be higher in price at the end of 2011, that's a harder call.
It's interesting because in 2010, I guess there was the war between the banks and the retailers for people's cash. Who do you think's likely to win in 2011?
The war is still on. I mean, we could be saying we're from the war room now. You know, I think that deposit war will continue on for quite a while. You know, it's interesting to us. We've seen some of the banks buying back their own US dollar debt. They're taking back that government guaranteed debt, and they're, you know, focusing their energies on winning that retail deposit war in that 1 and 2 year part of the curve. So I don't see that changing.
Good stuff. Thank you so much, Mark Todd. We appreciate your analysis this morning.
Pleasure.
Mark Todd from Big Securities in